Welcome back. This is Arise News. You're watching the morning show with me, Biola Labi. The Central Bank of Nigeria last week released new credit policy guidelines aimed at expanding credit to the manufacturing, agriculture, and other key sectors of the economy. The new guidelines comprise directives on the differentiated cash reserves requirement regime, as well as another one for corporate bonds. Joining us to discuss what this means for the real sector and the larger Nigerian economy is Olawale Edun and the Director of Locum Capital, Kamar Bakrin. Thank you, guys. Thank you for being on the show.
Thanks a lot for having us.
So, thank you for being back.
Thank
for
you.
coming back. Yes. So, as we just said in the introduction, the central bank released new guidelines last week. When a lot of people heard the guidelines, some people felt that it was exciting, some people felt like this will spur the economy. To start out and just to contextualize it, what were some of your thoughts when you heard the news? I'll start with you, Kamar.
Yeah, thanks a lot. First and foremost, I think whether it was the CBN that came up with this policy or jointly with the Bankers Committee, I think someone somewhere deserves like a national award. I think this is a potential game changer. Now, to put it in a bit of context, of course, this is not the first intervention we're seeing in Nigeria. As recently as 2014, I believe also 2016, if I'm not mistaken, there was a 300 billion naira intervention fund, yes. I mean, by the CBN in that particular instance. Similar terms, 9% interest rates, long-term tenor, 2-year moratorium and all of that. So, you know, similar thing. But I think probably what is absolutely inspired about this, in my view, is the sheer potential size of this pool of funding. If you consider that the total cash reserve ratio is in the region of about 4.3 trillion naira, which is about $12 billion plus minus, compared to like $1 billion that CBN had previously made available, so to say. You can see that it's like an order of magnitude difference. And therefore that holds, you know, a huge potential if, of course, properly managed. And, you know, I think we should spend a bit of time talking about
the management of that.
What that means. But overall, I think this is incredibly exciting.
And you?
Thank you. Kamar has said it all.
Very good.
Really, when we look at it from the point of view of what this administration, what this party, APC, promised us, committed to us in its manifesto, this is perhaps the first time that it is really coming out and giving us what it said it would give us. Single-digit interest rates for manufacturing, for agriculture, for the real sector. And as Kamar said, the order of magnitude is important. It carries some risk with it, because when you pump so much money into the economy at one time, especially Naira, there's issues of foreign exchange pressures and inflationary pressures, but those can be put aside for one moment. And what we can say is that the central bank, the Bankers Committee, the economic management team of the government, this is a time at which we should stand up and applaud them for even indicating that they're willing to go in this direction, which is what we need, because the opposite is failure, staring the government in the face in terms of its economic recovery and growth plan. 4 years of falling GDP. 4 years and 2 years of missing its targets. In 2017, the target was meant to be that the economy would grow at an average of 4.6%. It grew up 0.8%. So over the next 3 years, if it's meant to be growing 4.6% on average, and you grew at 0.8 the first year, and this year is likely to be perhaps 2%, you're talking about, and it should be almost 6% this year. And by the time you miss the target this year, it should be even higher. So you're looking at trying to meet a target which is going away from you all the time. This is one policy. This is one policy program, and this is one intervention that can at least help reverse that trend.
So there's when you look at a pessimist, there's been some pessimistic voices out there saying this is gimmicky, this is sort of political jockeying. What do you say to people that are saying that this is a little too late? This, like you said, the government had made promises 4 years ago, missing the targets one after another. Or do you think that at the end of the day, it doesn't really matter from a timing perspective? Wale, I would like you to start.
I think that we have to be optimistic. We have to accept that what's happened is that huge amounts of liquidity have gone out of the economy. By the time an economy that was getting $90 billion or so in 2014 is now getting 40, and it was down to 30-something last year. By the time that liquidity has gone out, it has to be replaced. Otherwise, you have falling GDP, despite the fact that, yes, the government, they have tried. They've stabilized the exchange rate, albeit on a basis that not many people are really sure of. Inflation has been coming down. But the key is liquidity, is growth, is jobs. People, when you see falling GDP, you're seeing poverty rise.
Yes.
And we now know that we have more people in this country than they have even in India, and they have 6 times our population. So those are alarm bells. That's a situation that calls for critical action. And this
is that critical action.
Is that critical action, and we should be positive about it. There's always cause for pessimism, but to me, honestly, this is a cause for optimism, and we must encourage and support those that are implementing this policy.
And what do you say to skeptics out there about this policy?
I mean, the skepticism has to be founded on something. I struggle to see the basis of it. I mean, like, when I looked at the policy, I thought, you want to start messing around with, CRR? And then I went and looked at other countries' CRRs. I mean, Nigeria 22.5% is on the higher end by far. There are countries like actually don't even have a CRR, so there's the concept of like a cash reserve ratio doesn't even exist. Now, yeah, of course, there are other extremes like Brazil and Turkey that are in the 40%, 30%. I mean, sorry, Brazil and Lebanon that are in the 40-30% range, but at 22.5%. I mean, so typical median CRR is about 2%, 3%, 5%. So, I mean, you can argue that there is something to play with in that. I mean, play is probably an unfortunate choice of words, but, you know, there's a
something to work with.
Exactly, to work with from that point of view. So I don't see that so much as an issue. I mean, the big risks that I see, which I think needs to be, like, addressed full on, actually, are around 2 things, in my view. On the one is, quite frankly, the bank's internal capacity to actually manage the credit around these 2 sectors. Typically because they have not been under pressure to lend to them, they've not been under, my own sense, again, partly based on first-hand experience with the banks, is I have a bit of concern about their ability to actually process credit around these 2 sectors, agriculture and manufacturing. Now, in the case of agriculture, you can argue that, there are potential sort of like, what would I call it, like backstops in the sense of like, agri insurance and what have you. But I do think the banks need to very quickly ramp up their ability to actually process credit around this, around these 2 sectors. That's the one. And then the second one, which is probably going to be a little bit controversial, is for those who can remember, in the 80s and early 90s, we did have some, like agri intervention funds. I think Mr. Edun will know this better than I do. We did have agri intervention funds. What typically happened, and let's be very honest about this, was that there was quite a lot of leakage. So people set up all sorts of spurious agricultural projects, and all of a sudden, companies that were importing cars were suddenly going into agriculture. You're thinking, hey, wait a minute, what's going on here? But quite frankly, it was actually a lot of leakage. So the agri projects were actually serving as conduits for, essentially financing through the back door the other businesses, and the agricultural sector did not benefit from it. Now, this has to be consciously managed because my sense is that the reason why these 2 sectors in particular have been selected is their incredible capacity, to generate employment. So it would be a shame if, you have these sort of things, and it is sabotaged by this sort of leakages as well. So it's extremely important that the regulator is super vigilant around ensuring that the money actually goes into that sector. And finally, what I would want to say around this is it's also very important to sort of like develop capacity in this space, capacity to actually manage businesses in the manufacturing space, to manage large, complex agricultural projects, including agricultural value chain type projects, is going to be extremely important to the success of this. So someone needs to be thinking about that capacity building as well.
Okay. I'm going to throw capacity out there because you mentioned capacity on many levels. So capacity of the banks, capacity of the people to actually receive the funds, and capacity of the people sort of in the middle of that. So this whole capacity ecosystem, which is a bit similar to where we were talking about earlier, even about the Ogoni cleanup project. So capacity now money's not the problem, capacity is the problem. Let's talk a little bit about capacity and how you see capacity, especially in the banks and then in the whole ecosystem, how that could be managed, because that is a huge risk.
Well, it is a huge risk, and implementation depends on the capacity that you have. I mean, the risk that Kamar has pointed out, yes, it's a very real one, that you do not actually achieve what you've set out to achieve, that the funds do not actually go in the direction that you want. Naturally, if you are in business and you're paying 20-something% and you see 9%, you're going to gravitate towards it. But at the end of the day, as long as the funds actually, whether it's from some of it is more or less a blend. You will have some loans that are high, and then you go to basically average down your rate of interest by taking on some of the funding that is at a lower rate, as long as it's for agriculture, as long as it's for manufacturing, whether it's existing, whether it's new. At the end of the day, it really doesn't matter, as long as you are creating jobs and helping to reduce poverty. So in terms of the capacity, the banks themselves, they have able people. We know we have the banking system that really is full of able people. It attracts good people. The issue for them is that they really do not have the capacity to lend as a whole. They've lost it because they were left with, if you note that before this intervention, loans to the private sector have been falling. So the banks have been retreating from lending to anybody as a whole and taking their money and just putting it in treasury bills.
Because at 20%, I mean 20, there's no lending that can happen, and that stalls the growth of the economy.
But this intervention and this scheme does give an incentive. It gives an incentive to the banks to take money that is locked up and earning zero. And at least if they can lend it out efficiently, nobody wants to lose their money, because if they lose their money, they're earning worse than zero, they're negative. So they'd rather even have it locked up at zero. But assuming that they can lend efficiently, they earn 9% when they were earning zero before. So that's a huge incentive. And I think those who are not capable and don't have the capacity will simply just not venture into that territory, because nobody will just throw away money. Beyond that, the real capacity that we need in this economy is really going to come from investment. In the same way that this is an addition to the liquidity in the system, and therefore to a basis for investment, and therefore growth and jobs and reduction of poverty, the real missing link is that we've lost a huge amount in terms of dollars, in terms of investment, and it has to be replaced. And yes, CBN can do its bit, like by floating perhaps up to $10 billion. But we can also see that there isn't the capacity to accept $10 billion in terms of inflation, in terms of the exchange rate, because a new investment requires machinery, requires raw materials, and as we know, we are import dependent to that extent. So where I'm going is that the real answer and the way other people have made up for shortfall of money and shortfall for other capacity is huge foreign investment. Saudi Arabia last year opened up its economy with a $200 billion privatization and foreign investment program. India has got to where it's got to by huge foreign investment. And that is the real area because, one, that brings technology, it brings capacity, and it brings liquidity of a type that you really need, which is dollars. We've borrowed roughly, I think, $7 billion in the last 3 years. Yeah. And even though some people have a quarrel with foreign borrowing, you need the dollars in the economy. However, if you lose 50 billion and you bring back 7 billion, you still have a huge shortfall. Absolutely. And the two are linked together. Absolutely. So really, in answering your issue and question about capacity, we need to bring in the capacity that comes with foreign investment as well as the money that comes with foreign investment. And why this particular policy is doubly important is that not only were we faced with falling loan lending to the private sector, we have a brain drain. The people that would be working in the banking system and working to intermediate these investments, analyzing them and making sure they're efficient, they've all gone to Canada, they've all gone to to foreign countries as they voted with their feet, seeing what they regard as economic failure and not wanting to be part of it. So that's an important part of the capacity, is to retain our own capacity. And without initiatives like this, and even more than this, the fear is and the danger is that we'll lose them.
Sorry, just to that point, I think the beauty of the Nigerian economy, I mean, something that people sometimes complain about, but can be a super positive here is, it's very much a copycat economy, right? So the moment you see a few sort of like landmark investments around this, for example, if this actually does take off, hopefully it does, and you hear there are announcements of a handful of significant investments, also, X-Bank just gave, 5 billion naira to these guys building like a cashew processing plant or like an integrated sort of poultry complex, you will see, there's the beauty of this country, just the sheer energy of it. Once those announcements are there, you'll see like, an acceleration of this. And what tends to happen, as we saw in 2000, 2001, during the privatization, is that this brain drain actually reverses pretty quickly. People's ears prick up. Oh wow, great stuff is going on in Nigeria. Like, what am I doing in all this snow and like, wearing this nasty winter jacket and like catching the train to work. I'm heading back home where I'm going to get a driver and a cook and live in a nice part of town. And,
has someone been telling you about my story? Have you been looking me up online?
So what can I tell you? I'm sure quite a number of us have been through that. So that's the beauty of this kind of things, like it quickly creates a virtuous cycle, and then it begins to attract the kind of people that Mr. Edun was talking about back into the economy. Another interesting part of it is, we get, I'm sure Mr. Edun does, I get those kind of calls from foreign investors saying, oh, we want to come in, we're looking at this, we're looking at that, but do you know anybody anybody locally we can co-invest with? Now, when capital is, sort of like choked up and it's not flowing, I mean, clearly nobody has the capacity to invest, but with this sort of development, it creates that liquidity in the system that allows local investors to also step up and participate. So, we really ought to be solidly behind this. So
this is so for you. This is an exciting opportunity of unlocking growth, unlocking the economy.
Absolutely, if properly managed, without a doubt. They need to create the supporting sort of like the enablers for this, whether it is like just enhanced credit training, whether, all sorts of like the necessary guarantee, credit guarantees that go with this, insurance, all the sort of things that sort of like form part of the ecosystem for this to succeed. We cannot stress that enough. Including things as, seemingly obvious, as knowledge transfer, because managing large complex businesses in the real sector is not something you take for granted. So whether it is like, sort of like strategic partnerships with offshore, entities that know how to do this kind of thing, it's very important part of the whole story. So it goes beyond just like, writing those big checks. to ensuring that the ventures actually succeed?
So one of the things, so you guys brought up so many different things. So I'm going to take this one first because I think this one we can talk about quickly, and then I want to get into actually the managing of the funds. When you talk about the brain drain, that's a very critical issue that I feel like this government hasn't addressed. 10 years ago, 12 years ago, there was a wave of people moving back to Nigeria because they believed that they can make a real contribution. I was one of those people that moved back. Today, I think 50% of the people that were in that cohort have probably repatriated back. What is it that, what do they need to see differently, and what are those levers that need to be switched on for that to happen, and how long do you think that takes with this new opportunity?
You definitely will see what you've seen. Young people, good people, people who can compete anywhere in the world will vote with their feet. So if you deliver a falling economy, if you deliver poverty, if you deliver illiquidity to them, they will go. By the same token, as Kamar said, they will very quickly turn around if you turn around the economy. And the issue here is that just in the way that what has been announced by the CBN has the potential to very quickly turn around the economy and get it going in the right direction, just as quickly people will come in and take those opportunities. It's been on the table since. I know, because I was part of the economic transition team that tried to draw up a blueprint, and it did draw up a blueprint. Using the cash reserve was one of those options, and we're very happy and relieved to see that it has been implemented now, it's being implemented now, and of course we pray and we assume that it will be implemented efficiently, and it needs to be built on in order to keep the momentum of an economy going in the right direction, because very quickly you come up against a foreign exchange constraint. So therefore, what needs to be done to encourage private investment, this is one important pillar. As Kamar said, you need credit guarantees, for example, rather than the government trying to use money it doesn't have. It has the ability to stand back and guarantee. If you have single-digit interest rates and you have credit guarantees and you open the door for private investment and make it conducive for them, that is really the way to not only reverse the brain drain, but to at the end of the day, grow the economy and reduce poverty. And these young people, they will see all those signals. I'm sure people, the next set on from you who are looking at what to do will open the paper and they'll look at 9% money.
Yeah,
and it's available to one and all.
Yes.
What we haven't talked about is that there are bonds also to be issued, and central bank says it would buy those bonds and encourage others to buy those. But the main point is that the 9% agricultural funding is agriculture and related sectors, and for manufacturing and related sectors, is for one and all. So it's for startups, it's for young people with trying to do business, and it doesn't have a minimum. It has a maximum of $10 billion, but it's for everybody. So for all those young people, the first thing they should be doing is looking at that 9% and doing whatever it takes to make sure they get it, because there they have a chance. And if you give them a chance, as you've said, and you know, they want to be here.
Yes.
They want to contribute here. They feel much more fulfilled here. But you cannot deliver poverty to them and tell them to accept it just because they want to be patriotic.
I agree. I agree. I want us to move to switch gears a little bit and look at what you've just said now, which is this is available to all. As typical in Nigeria a lot of times, and there's been evidence in the past that when these type of opportunities come open, you see people that are very well connected, people that have very good links to the banks. They're credit worthy, which is, at the end of the day, that's what a bank is looking for, that are currently selling cars and now all of a sudden will now become manufacturers and agriculturals. As you're looking at the bank sector and the banking structures and the banks that are now getting people to call, I'm sure people are calling their bankers now, what advice and what needs to be done to make sure that this does get to the right people? And not people that are not in agriculture.
Oh, who is the right person? in my view. I mean,
so you're in your mind, it's capital. Capital should be dispersed.
Yeah, I mean, like to be clear, and again, so before it turns into an echo chamber, I mean, I do agree with that. You know, who is the right person? Is the person who is able to borrow and repay,
Yes,
and in the process employs labor. I mean, for me, that
so
is
even
the
if
right
you're
person.
even if you're not in manufacturing and you're not in agriculture, as long as you're credit worthy, you should get access
hang
to
on.
this.
Just to be clear, no. The objective, there's a policy objective, which is to create employment. Okay, so long as you are using that money in sectors that, you know, sort of
Create jobs.
Create jobs. I think that is very critical, and you know, like a critical mass of jobs. Because, for example, if we put the money in oil and gas, we know typically upstream oil and gas employs very few people relative to sort of like industry revenues, right? Very compared to, say, agriculture. I mean, by a factor of like maybe 100 or more. You know, for every dollar of revenue, it's that ridiculous. So you don't want the money going into those kind of sectors, which in any case do not have any problem attracting capital. Okay, so you know, like a deliberate effort has to be made to ensure that the money does go into the sector. The point I thought you were making was around sort of the beneficiaries, as to whether it is connected people that get the money or the average guy on the street. I mean, for the bank, quite frankly, and I do sympathize with them, is the person who has the ability to repay. You know, so
No, the person that has the ability to repay, but making sure that sectoral. That's
that I think CBN needs to really sort of like be super vigilant around. You know, I think, and if it means involving the EFCC and you know, all of that, I think it's extremely important to ensure that the money goes into the sector. Otherwise, it will be another policy failure, you know, and actually, it will be a double whammy, because typically those guys who tend to do it, you know, they can borrow from other sources. So there's already that ability to crowd out that they have. And quite frankly, in some cases, if you want to take it to another extreme level, when they fail to repay, they're actually the hardest to go after. So that in itself can pose a systemic risk. So, you know, one needs to, you know, as we saw again in the early 90s, you know, when you know, people went rogue and, you know, so, you know, so we have to be, the CBN and the other regulators have to be super vigilant around this.
How does CBN do that, though?
Well, may I say that they shouldn't try too hard to do that, because if the incentives and the cheap money is for agricultural production, and that's where the profits are, the car seller will forget about the cars
and go into agriculture.
And at the end of the day, if you want investment, you can't have 20% interest rates.
Yes.
So it should be across the board. The issue is that we're trying to start somewhere, because we cannot cope with everybody borrowing at 9%.
Absolutely.
And the issue really there means that since we cannot cope with that, in terms of there'll be so much naira out there, and they'll be chasing foreign exchange and be causing inflation. So the answer is that even whether it's the federal government, state governments, individual companies, there's a limit at this time to borrowing. And what they need most is not borrowing. It is equity. It is investment, foreign direct investment. And why do we say foreign investment? Because you need those dollars. And really, in the same way that this government has focused on putting liquidity back into the system at reasonable rates, it needs to similarly focus on attracting dollars to this economy outside of the instrument of borrowing. And honestly, we will be there.
So I want to spend some time on FDI and also some of the work that this government needs to do. I mean, I think that if you look at the global communication and engagement, there is some lacking and wanting there, and the fact that the government, this government is not communicating to the world the opportunities in Nigeria, because there has not been a lot of great things to talk about like this. So when you talk about co-investing, tell us how foreign direct investment is going to sort of unlock some of that, and some of the some of the capital that is left will come back. But also, what work does the government now need to do in engaging the world to say, we've reopened for business? I don't know how to say it, but we are reopening for business. You know, we're we're retooling and we're opening.
Never closed our doors.
Yes. We've never closed our doors, but we've extended our opening hours. Let's say that we've extended our opening hours. What is the work that now needs to go in, and for people that are now going to be able to match investment because they can borrow at a rate that makes total sense now? What you know, as we embark on the FDI campaign, what do we need to do now?
The problem with the FDI campaign or foreign investment in general is that it's the investment climate. Unfortunately, at this time, what foreign investors like least of all is uncertainty. And what they like is predictability and certainty. Who's in charge? What is the policy? What are they going to do with the exchange rate? What are they going to do with interest rates? And so on, credit policy, and so on and so forth. We're moving into an election period, and so therefore, one has to expect some looseness in fiscal policy. Government will open the taps naturally. Foreign investors and all investors will take a back seat, and because they want to know who will be in charge and what their policies will be. So that's the background against which we're trying to talk about foreign investment. It is the trickiest thing of all to attract foreign investment, to attract investment anyway, but to attract foreign investment. And at this time, for us, it is foreign investment or bust.
The good news, though, is that, you know, again, from my recent experience in the sort of like private equity space, I know as foreign investors come into the country, they also seek an element of local financing. Yeah. I think it enhances, you know, investments for whatever it is, whether it is in form of working capital for their existing investments in the country, because you actually don't want to, I mean, you know, beyond sort of like investing in equity, I mean, like providing equity investment in a business, you typically, you know, tend to source working capital in the local market, as it were. I think this in itself creates an opportunity, you know, for that liquidity. Obviously, it creates, you know, that liquidity. So, for those who are already in the market, it enhances those, or those for whom this is sort of like the last piece of the puzzle before they actually make that investment commitment. This is a big plus. I mean, like, we saw that with a couple of portfolio, you know, companies that have been involved in my private equity sort of like space. So that is a big positive. The other thing is, yeah, I mean, the political outlook, you know, just by default is uncertain. But having said that, I think the rhetoric is not one that's
not warm and fuzzy for foreign direct investment today.
I don't think so. No, I don't think so. Actually, I don't think the rhetoric is that negative. You know, there's a lot of noise and a lot of, but it's almost, you know, how do I put it? If you really sit back and look at it very carefully, you don't, you know, unlike say 2011, 2015, where the stakes seemed like incredibly high, that has not quite been the case. Whether we like it or not, there's still a very clear front runner.
Sure.
You know, opposition has not quite coalesced around an individual figure, yes. The kind of thing that causes serious polarization in the country. Quite frankly, if you ask foreign investors, and so I stand to be correct, if you ask foreign investors, you know, they're probably not as alarmed about the outlook in terms of sort of like February 2019 as sort of.
I think also. Do you think also too from a global investment? First of all, there are a lot of other hotspots around the world. Nigeria's story starts to emerge as more of a more coordinated. It doesn't really sound as erratic as it might have sounded in 2011, where there weren't so many hotspots around the world. And also, there is a sense that we prepared people that this is a bit of our process. Do you think that's also playing into sort of the lack of negativity that you're feeling?
And 2015 has 2015 has helped. The sort of like the fact that a democratically elected government could actually lose power and hand over. You know, has also helped to give the sense that, you know, maybe there's some sanity in this place after all, and elections are not necessarily sort of like the wars that they were in the past. So, I think overall, I mean, again, I'm quite optimistic in terms of just overall outlook. It doesn't mean absolutely it's a walk in the park, but my
so
sense
they're
is,
telling me that I have to wrap up soon, but I really have something important that I want to discuss before we do that. Yesterday we had a panel talk about going back to school and the education and education indicators in Nigeria, and really their job at school level now is to prepare kids to go into this world of capacity that we've been talking about. Kids that enter into GSS 1 today will be ready for the job market in 2030. That was a big part of our conversation yesterday. The World Bank had released a study 2 years ago that Nigeria has to create almost 30 million jobs to accommodate this upcoming generation, this job market. A lot of that has to live in micro enterprises. Yes. Do you think this is good news for those micro enterprises, especially the agricultural sector, which is where most of these jobs will live? And what should micro entrepreneurs be looking at and accessing this?
When we're talking about jobs as a whole, we're talking about the investment. For micro enterprises, when the reality is, this 9% money, this initiative, the biggest companies are going to be in pole position to get it. And they're in pole position because those are the people that have the credit worthiness other than, for instance, a micro enterprise. Sure. And also the volumes, the scale that we're talking about, micro enterprises are not going to take us there. We need huge foreign investment in the economy. Right now, you have a situation where the European markets, the US markets are much, much easier. They are more attractive. So they are staying at home and investing there. So we really have to set our stall out in order to create the jobs for these children that are going into GSS 1 now. In order to have those jobs, we have to have investment. And it has to be foreign investment, and we just have to do everything that it takes to attract that investment over a long term. And that is by the government saying, we are open for business. This, and this, and this are the areas in which we will encourage investment, and this is how we will stand by it with cheap money and with guarantees. So really, when we talk about jobs for our youth in the future, it has to be because we have a growing economy that is creating those jobs, and they will be taken up as part of the employable people of the day, rather than specifically trying to target the kind of companies that we may need to grow so that they can have jobs. It's everybody will be floated by the same tide, and that tide is investment.
But
I'll give you closing.
Yeah, don't forget also that when the large businesses do well, they invariably outsource stuff. So, an MTN will issue an LPO to, sort of a small guy to build like a tower for them, or to supply diesel and things like that. That trickle-down effect as well. If a guy has an LPO from a reputable blue chip company, it's easier for him to get. He's going to get financing for it. So there's that knock-on effect which everybody will benefit from. But I do agree that you need the large guys. The big guys should drive this thing, because again, they're the ones that have the capacity we've been talking about. They have the managerial ability and so on, whether we like it or not. They're the ones that have it. But the trickle-down effect from the business-to-business sort of relationships also will benefit the SMEs, and sort of the overall effect on the economy's increased employment.
So we have a lot of work ahead of us, is what you're saying.
But also the future looks a bit rosier than it did last week.
Let's put it together.
Well, thank you so much for being here. It's always a pleasure. Now we have to see how this all trickles down into the economy. Thank you.
Thank you.
That's all from Olawale Edun and Kamar Bakrin. We will be going on a short break. When we return, we'll be taking a look at what's trending around the world. Stay with us.